Hi, my name is Benjamin Butt and welcome to this screencast on adjusting entries. During this screencast, we will be looking at what is an adjusting entry, why adjusting entries are necessary, the types of adjusting entries, and the important things to remember when dealing with adjusting entries. An adjusting entry are entries made in the general journal to record revenues that have been earned but not recorded and expenses that have been incurred but not recorded. When dealing with adjusting entries, it's important to always remember and keep in mind the accounting equation: assets equals liabilities plus owner's equity. The accrual basis of accounting states that revenues must be recorded when they are earned and expenses paid when they are incurred. Businesses often provide a service or earn revenues without being paid in cash straight away. Likewise, businesses can receive a service or incur an expense without having to pay for it straight away. When this occurs, it's necessary for accountants to use adjusting entries in order to maintain the accrual basis of accounting. There are four main types of adjusting entries. Firstly, there is deferred revenue, which is when a company receives cash before they earn the revenue. Deferred revenues are recorded as a liability because the revenue hasn't been earned when they receive payment. An example of this would be when you purchase an airline ticket. You have paid the airline company for your ticket before receiving the service they provide. The second type of adjusting entries is deferred expense, which is when a company pays cash before the expense is incurred. Deferred expenses are recorded as an asset because the company has paid for, but not yet used, the resource. An example of this would be paying rent for a period of time in advance of you actually occupying a house or flat. The third type of adjusted entries is accrued revenue, which is when a company receives cash before it provides a service or product. Accrued revenue should always increase a liability account as the company is yet to provide the product or service. An example of this would be when a company provides a service to a client and then once they have completed the work, they bill the customer and collect the payment at a later date. The final type of adjusting entry is accrued expense, which is when a company incurs an expense, however don't pay it until a later date. An accrued expense is also always recorded as a liability as the company is yet to pay for it. An example of this would be when a company employees work for a full week, however aren't paid until the end of a fortnight or month. Finally, there are a number of important points which you must remember when dealing with adjusting entries. The purpose of an adjusting entry is to record revenues that have been earned but not recorded, and expenses that have been incurred but not recorded. Every adjusting journal entry will affect at least one revenue and one expense account, as well as at least one asset or liability account. This means that every adjusting entry will affect at least one account from the income statement and one from the balance sheet. Adjusting journal entries arise because of the timing of revenue and expense recognition differs from the exchange of cash. Therefore, cash will never be increased or decreased when adjusting entries. Thank you, and I hope you enjoyed listening to this screencast.